let's take a look at the bigger picture. Ed Siddell's with us, CEO and Chief Investment Advisor at EGSI Financial. Ed, nice to see you. So how are you feeling about the market? You thinking about maybe a silent recession? What does that mean?
Yeah, well, thanks for having me back. Silent recession, I say it like that because it may not meet the definition of a recession, but everyday America, they're feeling it in the household at the end of the month. The money just isn't going as far as it needs to. And so people are going into debt using their credit cards just to be able to meet their monthly expenses and bills. So I think that's going to create a
little delay, and I did want to hear more about what you were saying about the consumer and that just their dollar doesn't go as far. And so you are concerned that with inflation that folks will behave differently, right? That could affect everything from CPI, maybe inflation will come down, but jobs and spending and all that, right? Savings are being depleted.
All the way across the board, that $2+ trillion in savings, that surplus is all but depleted right now. We've got, over, $1.2 trillion in credit card debt. Credit card rates are sky high. I think the average is over 20%. I just saw where Macy's credit card is over 34%. And so that all adds up. And then, compounding that whole thing is that student loans, borrowers have to start repaying that back October 1st. So, it's a cumulative effect that's going through. Right now, a lot of the jobs, people are looking at it saying, well, you know what, we're adding a lot of jobs to the economy, but the jobs that have been lost are higher paying, typically with benefits, and they're being replaced by lower paying jobs, usually in the service and retail industry, and so those are typically second and third jobs. So I think we're feeling the pain right now, and even pain at the pumps because we're seeing the cost of energy go up, and that's really affecting everyday Americans.
Yeah, and so, as investors, people are expecting some choppiness and volatility. September, traditionally, as you know, it's not a great month anyway.
You're absolutely right. It's bumpy, and historically, when August is a little rocky, that makes September even, a little bit more volatile. I think right now, because everyone says, well, what are the buying opportunities? I don't think that any have really presented themselves right now. I mean, even energy, I like it, but it's time to be cautious because even though OPEC is really not going to produce anymore until January, the slowdown in China and overseas, that could affect things. So, once we get through the Fed meeting, see how the market reacts, if they've already priced in a rate increase, and if the Feds actually do increase rates, which I think they will, then we can kind of look at October going forward and see, what opportunities that we have in the markets.
When we think about the Magnificent Seven and some of these names that have pulled back, right? Some are down 10% off the highs or more. I mean, Apple, for example, this week is down over 5%. Are there opportunities here on a pullback, or are you waiting because you still think it's expensive for names like that in tech?
Yeah, you know what? I still think it is. You brought up Apple. With what China is doing, the impact that's going to have on Apple, I'm still not sold on the fact that that's a good buy right now. But they're a solid company. I mean, they have billions in savings in the bank. But I think the opportunity is probably going to be a little bit later. In buying on that dip. I'm just not convinced that now is the time.
I see, understood. So is there anything that you would be buying now or putting money to work, or are you waiting and saying, I have some cash on the sidelines and this could be interesting soon?
Yeah. Right now, we've got a lot of short-term treasuries, a lot of cash on the sidelines. We're positioned to take advantage when things kind of turn around, and if we see some really good opportunities and some good buys. But right now, I don't think that this is the time to do that. I do think that next year, the market is going to rally because, it's about the economy. I would not be surprised, I'd bet even money on it, that the Feds are going to, lower rates at least once, if not more next year. Gas prices are going to go down, just in time for the election. And if we see that, we're going to see a rally. So if you're positioned properly, you're going to be able to take advantage of that.
Yeah, I mean, there are some people who are calling for a Santa Claus rally, for example. But I did think, I know you're watching the inverted yield curve very closely, but you said math is telling us one thing, and the market seems to be ignoring the math or the data. Explain that.
Yeah, when you're looking at the number of bankruptcies, bankruptcies are up over 17% just in the month of August. Corporate as well as consumer. We're looking at all this financial data that's saying, well, even manufacturing is down. 8 months in a row, and that's a really good sign, a negative sign that there's a financial issue on looming on the horizon. Last time we saw that was the housing bubble. The time before that, it was the tech bubble. The time before that, it was the S&L failure. So there's a lot of data that's saying caution is the operative word right now. But again, if there's opportunities, you just need to make sure that you don't risk what you have for something you don't need. That's probably the best way to say it right now.
Right, a good way to hedge or just sort of be cautious in this type of environment. Ed Siddell, nice to see you, EGSI Financial. Thank you, Ed.